Hello, in this video we'll be discussing liabilities from advanced collections. So real quick, first let's just define what is a liability. And a liability is basically it's a debt that is owed from a company to another entity. And we say it's a present obligation that needs to be satisfied with some sort of economic benefit, whether that's cash or another current asset, or could also be a different current liability. In this video, we're going to talk specifically about liabilities from advanced collections, and these are liabilities that are created when a company receives cash and has not either earned the revenue or remitted the money back to whoever it's due to. The advanced collections fall into three buckets. First, you have deposits. Sometimes companies get refundable deposits, or you can have advances from customers, which we will go through. Companies also get money for gift cards for which can be redeemed at a future date. And companies also do collections for third parties. So they collect money and then they have to remit that to a third party. Let's go through a refundable deposit example. Rancor Chemical Company sells combustible chemicals in expensive reusable containers. Customers are charged a deposit, so they're charged a deposit for each container delivered and receive a refund when the container is returned. Deposits collected on containers delivered during the year were $300,000. Deposits are forfeited if the containers are not returned within a year, and 90% of the containers were returned within the allotted time in this example. So how do we record this $300,000 of cash that we receive? Let's go through that example first, and then I'll discuss this final bullet point. When the deposits are collected, this is just a deposit that will hopefully just be refunded back to the customer. So the company receives cash, so they debit cash for $300,000. And as long as the company is holding that cash, they owe the customer that money back. We're going to record a liability. So we're going to credit liability called refundable deposits for $300,000. The problem says that of this $300,000, 90% of the deposits were returned, which means that 10% were not. Okay, so therefore the company gets to keep the cash for 10% or $30,000. It says deposits charged are twice the actual cost of containers. The inventory of containers remains on the company's books until deposits are forfeited. So when this company sells these chemicals in these containers, the containers remain in their inventory on their balance sheet. And so only when they are not returned, within the allotted time, then the company has to take it off its balance sheet, that inventory for that container. So it said that 90% of the containers were returned within the allotted time. So when they're returned, right, we give cash back to the customer. So we're going to credit cash for $270,000, which is the $300,000 times 90%. And we're going to reverse that liability because we've paid it out, so we don't owe the customer money anymore. So debit liability, refundable deposits for $270,000. So what do we do with the $30,000 or the remaining 10% of the containers that were not returned? We have to reverse the remaining liability because they're not returned, so we do not owe that money to the customer anymore. So we're going to debit our liability, refundable deposits, and at that point, it's the containers are not returned, so it's like the company made a sale. So they're going to record revenue, sale of containers, credit $30,000. Now they have to take these containers that were quote unquote sold. they have to take the inventory of the containers off of their books. And this is where that other bullet point, this that the deposits charged are twice the actual cost of containers. So if the deposit was $30,000 that was forfeited, that means the cost of the containers was $15,000. It was, so 15,000 times 2 is what we charge for the deposit. So we're going to credit inventory of the containers for 15,000, and the debit goes to cost of goods sold. It's just like a typical sale is made when we take off the inventory off our books. It's going to be debit the cost of goods sold, credit inventory. Advances from customers are when a company receives cash from a customer in advance and for a product or service that will be provided at some point in the future. So the company receives cash and they owe a product or service to the customer, so they will record a liability for the cash received. In a good example, here are some examples of advances from customers, such as a gift certificate, magazine subscriptions, some sort of deposits, airline tickets. So if you think about the airline tickets, when you purchase an airline ticket, you purchase it in advance and you remit your cash to the airline. When they receive that cash, they now owe you a flight. And they don't recognize the revenue from that cash until that flight takes place, until they've actually earned that money. So when they receive that cash, they still owe you a service, and so they book a liability. Let's go through an example. Tomorrow Publications collects magazine subscriptions from customers at the time subscriptions are sold. Subscription revenue is recognized over the term of the subscription. Tomorrow collected $20 million in subscription sales during its first year of operations. At December 31, the average subscription was 1/4 expired. When it says 1/4 expired, it means that they've provided, 1/4 is 25%. They've provided 25% of the magazines that were under subscription. So when they first collect the cash, this is all in millions, they receive cash, so debit cash 20 million, and they're going to credit a liability. And now this is a deferred revenue type of liability. It's called deferred subscription revenue, okay? So sometimes it's also called unearned revenue. You'll see that from time to time as well. As the subscription is utilized or is used, right? They send the magazines to their customers. That's when they earn the money that they've collected. And at such point, so they tell us at 12/31 that a quarter of their subscription was utilized. So we're going to debit the deferred subscription revenue for 25% of that. So that's $5 million, because now remember, this is a liability. So now we don't owe this much money to our customers because we have actually earned that money. And we're going to credit subscription revenue that goes on your income statement for the $5 million. Let's go through another example. Perkins Inc. accepted an advance of $2,400 on December 1 for providing IT help desk services for the following 6 months. So this is a 6-month contract, if you will, or money for services for 6 months. Perkins estimates fulfillment of its performance obligation based on the passage of time. So that's how they recognize their revenue, or that they've earned that money based on the passage of time. So, and on December 31, Perkins will make an adjusting entry that includes a credit to revenue of what? So basically on 12/1, they received cash for $2,400 and they credited deferred revenue. This is a liability for $2,400. Now on 12/31, and this is for 6 months. So on 12/31, they've essentially 1 month has passed, so they have earned that that money because they have provided whatever services were needed. So on 12/31, they're going to debit their deferred revenue for 1/6. So 2,400 because they've earned one out of the 6 months, which equals $400. So we're going to debit deferred revenue for $400, and then they're going to recognize the revenue on their income statement for $400. So the answer will be D. Gift cards are another sort of advanced collection, and when a company sells gift cards, they still owe a product or service to the customer who receives that gift card. So they receive cash in advance. So when do they recognize the revenue on that gift card? Typically, they recognize the revenue when the gift card is actually redeemed, right? I receive a Target gift card. I go to Target, buy my stuff, and use my gift card. I have now redeemed the gift card, and Target has now provided the product, so they no longer have that liability. However, not all gift cards are redeemed, and it's called once a gift card gets to the on breakage point, it means that there's just a remote probability of redemption. And so over history of the company will know that typically, I'm making this up, 10% of all gift cards will not be redeemed. And so at that point, once they've reached this on breakage point marker, then they can also record the revenue for those gift cards, even though they haven't been redeemed. So during May 2027, Great Buy Inc. sold $2 million of gift cards. Also during May, $1.5 million of gift cards sold in prior periods were redeemed by customers, and $1 million of gift cards sold in prior periods expired and were unused. In this example, the gift cards were actually expired, but if the gift cards were not expired, but the company, based on the history of the redemption of gift cards that they know about, that they think that $1 million of gift cards reach that breakage point, they can also recognize the revenue at that point. But let's go through, there's three things. There's a 2 million, 1.5, and 1 million. Let's go through each of these journal entries. When they first sell the $2 million of gift cards, they receive cash, debit cash, 2 million, and now they have a liability because now they owe products or services for those gift cards. So they're going to credit deferred gift card revenue of $2 million. In May, $1.5 million of gift cards sold in prior periods were redeemed by customers. So now that they've been redeemed, the company has provided their product or service, right, for those gift cards. And so they can credit revenue, they can recognize the revenue for $1.5 million, and they no longer owe that part of the liability. So they're going to debit the liability for 1.5. Just so you know, this entry is ignoring entries to inventory and cost of sales. So if this was let's just say we sold TVs and this is what it was redeemed for, we would have to take those TVs off of our inventory by debit, cost of sales, credit inventory. But for this purposes, we're not showing that journal entry. And then we're going to go to the $1 million of gift cards sold in prior periods that were expired and were unused. So if they're expired, they can no longer be used, or we know based on the breakage point that they won't be used. The likelihood of them being used is very remote. We're going to debit deferred gift card revenue for $1 million. And at that point, we can also recognize the revenue from those gift cards for the $1 million. Another example, Ling Inc. sold $30,000 of gift cards during 2027. So I'm going to go through and kind of just write out the entries as we go along. So entry 1 is that they sold $30,000 of gift cards. They're going to debit cash, $30,000, and credit deferred revenue. $30,000. That's check. Also during 2027, $25,000 of gift cards were redeemed, some of which were sold in 2027 and some of which were sold in prior year. The fact that they were sold during the current year and prior year is irrelevant. As long as the gift cards were redeemed, we have to record all of that. So our second entry, oh, actually, before I go to my second entry, I'm going to do a little T account just for the deferred revenue because we're going to need it. For this journal entry number 1, we have a credit of $30,000. Okay, now $25,000 of gift cards were redeemed, right? So therefore now we have earned that revenue and we no longer owe that liability. So we're going to debit deferred revenue for $25K and we're going to credit revenue on the income statement for $25K. So here I have a debit to deferred revenue, so I'm going to debit $25,000 in my T account for deferred revenue. Ling also, so that's this. Ling also concluded that $2,500 of gift cards sold in the prior year would never be redeemed. Okay, so let's just stop right there. So if they're never going to be redeemed, that means we can recognize that revenue. It's going to be the same entry, number 2 and number 3 is the same entry. It's going to be, except that it's going to be for a different amount. It's going to be the 22.5K here and 2.5K here, right? We're going to debit revenue for $2,500 and credit, I'm sorry, we're going to debit deferred revenue for $2,500 and credit revenue for $2,500. So here I have another debit for $2,500. And then finally it tells us that Ling finished 2027 with a balance of $17,500 in deferred revenue. So if I look at my ending balance for deferred revenue, it's telling me it's $17,500. So how would I get? So if I take my 30,000, right, minus 25 gets me 5,000, minus 2,500 gets me a credit balance of 2,500, right? So, but the ending balance was actually 17,500, which means that there must have been a credit for $15,000 during the year as well. So if I have a credit to deferred revenue for $15,000, that must mean I received cash for $15,000. The problem says Ling should recognize revenue in 2027 for how much? Well, this is our deferred revenue account. So this is our liability account. It's asking for the revenue. How much revenue do we recognize? Well, we had 2 entries for revenue, one for 25,000 and one for 2,500. So our revenue for the year, so total revenue is going to be the 27,500. If the problem would have said, given you all this information and said, so you just have this T account here and said, how much additional cash did Ling get during the year for these gift cards? The answer would have been 15,000. So there's just different things that they could ask based on this question. Collections for third parties is the last type of advanced collections we're going to be talking about. And this is when companies make collections for third parties from either their customers or their employees, and then they have to remit them to other agencies. So common examples are taxes, right? When you get your paycheck and you earn $1,000 and then you look at your paycheck and it's $900, and let's just say that $100 difference went to income tax. That's because your employer has withheld that income tax, right? So, and then they owe that money to the IRS. They don't get to keep that. So because they owe that money to the IRS, they have to remit that to the IRS. They're going to record a liability for that. So that's what collections for third parties means. Our last example, assume a state sales tax rate of 4% and a local sales tax rate of 3% a sale is made for $100. So we've made a sale for $100, and basically there's $7 of different kinds of sales tax. So we received, right, when you make a sale from your customer, you received $107, whether that's cash or accounts receivable. But your sale, right, the item that you sold you sold it for $100. So your revenue is $100. So that remaining $7, right, which is $100 times 7%, is the company has to remit that to the state and city, let's just say, for these sales tax. So as of right now, the company received that $7 and they have to remit that. So they have to record this liability called state tax payable for $7. Once they send that to the city, they're going to debit the sales tax payable. They're going to debit that, right, for $7, and they'll credit cash for $7 when they actually remit that.